Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. This is the fourth theory video on unit number 1, Introduction to Financial Accounting. First video I have explained you about the meaning of the term financial accounting, objectives, advantages, limitation. Second video on accounting concepts and accounting conventions. Third video, implication of accounting concepts and conventions on the accounting system and what is double entry system, advantages and disadvantages. These 3 videos already have completed. Now this is the 4th video. Now in this video I am going to explain you about the accounting process or accounting cycle. What are the steps involved in accounting cycle? Then what are the different types of accounts? Personal account, real account, nominal account. What is the meaning? What are the rules? Then I am going to explain you about book of original entry and subsidiary books. That is books of prime entry and books of permanent entry. That is journal and ledger, format of journal, format of ledger, posting, balancing of account, and advantages and disadvantages of journal. These are the topics very important, not only from problems point of view, but also in examination theory you will get. Remember, the theory is the foundation of the problems. If you cannot be able to understand the theory, then definitely your structure, your complete accounting knowledge is completely baseless. That's why don't ignore, don't underestimate the theory. Watch the theory video, be acquainted with the concept. Then only you can enjoy doing the problems. You will have a lot of confidence on the subject. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject accounting for management. Select the videos unit number 1, watch the first 3 videos, be perfect. Now take the screenshot of the points which I have written on the board, then I'll explain every point in detail. Now the first topic in this video is accounting cycle or accounting process. Actually, process means an activity which consists of a number of activities in a sequence. The activities are repeated in the sequence in the same manner. That is called cycle or process. So the accounting cycle is a complete sequence of accounting procedure which are repeated in the same order each accounting period. So every year the same procedure is adopted. The sequence of procedure will be same every year. That means first step, then second step, then third step, then fourth step. Like that it will be repeated every year. This repetition of the similar activities, same activities every year, that is called accounting process or accounting cycle. It's a sequence of activities that involve recording, summarizing and reporting of economic events in a specified manner. So accounting consists of recording, classifying, summarizing, analyzing, interpreting. These things are repeated every year, one after the other. First recording will take place, then classifying will take place, after that summarizing, after summarizing, analyzing, interpreting, communicating. These steps are continuously followed one after the other every year in a specified manner. That is called accounting process or accounting cycle. As an information system, this accounting is information system because accounting will generate the information, will provide the information to the management, to the decision makers to take important decisions. So it's an information system. The accounting cycle starts with recording of events and ends with the preparation of summary information in the form of financial statements. The first step in the accounting process is recording the transaction, and the last step in the accounting process is preparing the financial statements. The begins with recording, ends with preparation of financial statements. In between, other steps are also there. Then the user of these financial statements make judgment on the basis of these documents. Nowadays there are many stakeholders in a business. Every stakeholder has to take some or the other decision. And these financial statements which are prepared by accounting process will be very much helpful to decision makers. Like management has to take the decision. Management use financial statements. The banker, in order to give the loan, they want the financial statements to take the decision whether loan should be given or not. Investor, before making the investment, investor wants to analyze the financial statements. If he is satisfied, then only he will make the investment. So many parties, government will see the financial statements to implement the tax. So we can see financial statements are very, very important end product of accounting on which so many decisions are taken. And the financial statement should show a true and fair view of the financial activities of the business. So this explains the accounting process. Then what are the steps? The following steps are carried on in accounting process. The first step is identifying the transaction. See here. First of all, the accountant has to identify the transaction. How to identify? Every transaction must be supported by a document like sales invoice, purchase invoice, debit note, credit note, bank statement, invoices, vouchers. All these are the documentary proof of the evidence. So identifying the transactions with the help of documentary proof, that is the first step in accounting process. Secondly, analyzing the transactions. So once the transaction is identified, now we have to analyze the transaction, see how much is the amount involved, what is the date, what are the other details written. So everything should be analyzed, then only it should be recorded. So first identify the transaction, second analyze the transaction and see everything is perfect. Then thirdly, recording, journalizing. Journalizing is the process of passing the journal entries in the primary books. First book of original entry in which transactions are recorded, journal. So recording the transaction in journal is called journalizing. This is the third step. 3 steps completed. We have recorded the transaction in the journal. Later on, periodically, we transfer the journal entries from journal to ledger. It is called posting. So ledger posting. Transferring the entries from journal to the ledger. Next, preparing a trial balance. This identifying, analyzing, recording, ledger posting, this will be continued throughout the year. Now at the end of the year, we take all the debit and credit balances in the ledger accounts and prepare a trial balance. So preparing the trial balance is the next step. Next one is adjustment entries. Before making the financial statements, some adjustment entries are required, like closing stock, outstanding expenses, income accrued, income received in advance. All these are the adjustments to be made. This is the next step. And the last and final step in the accounting process is preparing the financial statements. That is preparing the trading profit and loss account and balance sheet. This is the end. This is the end of the accounting process. From next day onwards, again new process, new cycle will begin. The new cycle will begin from identifying the transactions, analyzing the transaction, journalizing, ledger posting, preparing. So these are the steps which are repeated every year, one after the other. So these steps are the steps in the accounting process. It will get repeated every year. That's all. So in examination, you may get a question like explain the accounting process. So whatever I've explained right now, that will be enough for writing an examination. Now, types of accounts. Account means a place where all the like transactions are put. A place where all the like transactions are recorded. That is called an account. So every transaction will have a separate account like sales account, purchase account, sales return account, purchase return account, salary account, rent account, telephone bill, electricity bill, customers account, suppliers account, bank account. All these are the accounts where the transactions, like transactions are put at one place. That is called account. Now accounts are broadly classified into 3 categories: personal account, real account and nominal account. The personal account are the accounts in the name of the persons, whether the person is a natural person or an artificial person. Natural person, we are all natural persons. So every business will open a number of accounts in the name of natural persons. The persons may be customers, the persons may be suppliers. So different persons are the natural persons. Apart from the artificial person, the person which is created by law. Example, a joint stock company, a public corporation, A company which is formed by the law is called an artificial person. That is also a person. So accounts of all persons are called personal accounts. Second one is a real account. The account relating to assets and properties are called real accounts. Example, cash account, building account, machinery account, furniture account, motor vehicle account, goodwill account, patent account, etc. etc. These are called real accounts. The third one is nominal accounts. Nominal accounts are accounts relating to expenses, losses, incomes and gains. These are called nominal accounts. So classified all the accounts into three: personal, real, nominal. Now what are the rules of debit and credit? For personal account, the rule is debit the receiver, credit the giver. When we sell the goods to the customer, customer is the receiver, his account should be debited. When we purchase the goods from the supplier, supplier is giving the goods, so supplier should be credited. So remember the rule for personal account: debit the receiver, credit the giver. Secondly, real account. For real account, debit what comes in, credit what goes out. Whatever is coming in, that should be debited. Example, cash is received, cash is coming in, cash should be debited. Similarly, machinery is purchased, machinery is coming in, machinery should be debited. Furniture purchased, furniture coming in, furniture should be debited. Similarly, furniture is sold, furniture is going out, furniture should be credited. Machinery is sold, machinery going out, credited. Cash is paid to the supplier, cash is going out, cash should be credited. Debit what comes in, credit what goes out. The next one is nominal account. Debit all expenses and losses, credit all incomes and gains. Number of expenses are there, losses are there. Example, salary paid, rent paid, telephone bill paid. These are the expenses, debit all expenses. Similarly, losses are there, bad debts loss, discount allowed. So this bad debts discount allowed is a loss, that will be debited. Similarly, credit all incomes and gains. Interest received, commission received, rent received. This received item will be credited because these are the incomes. That's all. So I have explained real accounts and types rules in the accounts. Next is book of prime record. There are two types of records: books of prime record and books of secondary record. Books of prime record are those records in which the transactions are first recorded. Whenever transaction takes place, first it is recorded in the books of primary record. The journal is the book of primary record. Now secondary record. After journalizing the transactions, entries are posted to ledger, second step. That means after recording all the transactions in the journal, periodically we post the transaction from journal to ledger, that is posting. And so ledger is the book of secondary book. So ledger is the secondary book, journal is the primary book. Now journal. What is journal? Journal is a book of original entry where the transactions are first recorded. As soon as the transaction takes place, it is first recorded in the journal. So journal is also called the book of prime entry or book of original entry in a systematic manner. So what is the format of the journal? Date, particulars, LF. LF stands for ledger folio. Folio means number. Ledger number. In ledger, every account is on a separate page. That page number is written. So page number of the ledger account will be written here in LF. Debit column, credit column. So totally 5 columns we have to open: date, particulars, LF, debit, credit. This is the format of journal. Now ledger. Ledger is an accounting book wherein journalized transactions are being classified. First of all transactions are mixed up in the journal. Whereas in ledger, we classify the transaction into group. All the like transaction will be put at one place in the form of an account. Like all salary transactions will be put in salary account. All rent transaction will be put in rent account. So ledger is a book in which all accounts are opened. So it contains all the accounts in the nature of personal account, real account, nominal account. All accounts are opened in ledger. Posting. It is the process of transferring the transactions from journal to ledger. So periodically all the transactions will be taken from journal and it is posted to the ledger accounts. That is called posting. Format of ledger. Ledger will consist of two sides, debit side, credit side. So 3 columns we open on debit side, 3 columns we open on credit side. The 3 columns on debit side are date, particulars, JF, amount. JF stands for journal folio. That means the transaction which you are posting here is coming from which page number from journal. In journal we have page numbers. So in which page number of journal the transaction is being posted to ledger. That is JF. Then amount. So 1, 2, 3, 4. 4 columns. 4 columns on debit side. Date, particulars, JF, amount. Same 4 columns on the credit side. Date, particulars, JF, amount. This is the format of ledger. Next comes balancing of ledger account. After making all these journal entries, ledger posting, at the end of the year, we have to find out the balance in every ledger account. Some ledger account may show debit balance, some ledger account may show credit balance. So at the end of the year, every account we have to find out the total on the debits column and the total in the credit column. Some accounts are there where both the totals are same, debit total and credit total are same. That means account is closed. But many of the accounts are those where debit side and credit side are not equal. Example, in an account debit side is 1 lakh, credit side is 80,000 only. That means 20,000 is the balance difference. That 20,000 is called the balance, and that 20,000 will be written on that side where the total is less. The total is less on the credit side. So credit side we write on by balance carried down. By balance carried down. Then take the totals. After taking the total, on the debit side, opposite side, you take to balance brought down. The balance carried down above the total and balance brought down below the total on the opposite side. If you are getting carried down on credit side, brought down on debit side. If you get the carried down on debit side, brought down on the credit side. That is called balancing. Now the last thing is advantages and disadvantages of journal. Journal advantage. The first is permanent record which provide information in chronological order. Chronological order means date wise. So we have arranged all the transaction on the date wise. On a particular date what the transaction took place. So according to the date wise we have recorded all the transactions. So it will be very easy to find out when the transaction took place, which transaction took place on that particular day. Secondly, provide information about debit and credit with explanation. After every transaction written in the journal, we will write the narration or explanation. So explanation will give more information about the transaction. Next comes minimizing the possibility of error. If we make the journal, then all the transactions are recorded, nothing is left. So there is less possibility of committing the error. Journal provides the complete information about the adjustment made at the end of the year. Before making the financial statement, a number of adjustments have to be made regarding closing stock, outstanding salary, prepaid insurance, etc. So many adjustments are there. So these adjustments are recorded in the journal. So journal will provide not only the transaction but also the events or year-end adjustments. These are the advantages. Now what are the disadvantages of journal? First, preparation of journal is a long and lengthy process. It's not so easy to maintain the journal because each and every transaction must be recorded. Suppose if the business is large, huge business, so many hundreds and thousands of transactions are taking place every day. All the transactions are recording, means it's a lengthy, time-consuming process. Secondly, it is difficult to post each and every transaction in the ledger. Double work, duplication of work is there. First we are recording in the journal, later on we have to post it into ledger account. So posting to ledger account, again a big burden. Then third one, possibility of committing errors. It is not like keeping a journal means we are completely error free. even after keeping the error, there is a possibility of committing the errors. That's all. So in this video, I have explained you about the accounting cycle, then what are the different types of accounts, rules of accounting, journal, ledger, posting, balancing, advantages and disadvantages. This is very, very important. Remember, you have to watch not once, twice, thrice. Then only you can be able to get the perfect knowledge about this accounting. You can enjoy learning the problems also if you understood the concept. So don't underestimate the theory videos. Every theory video is very, very important. I am putting my 100% effort in explaining. So if you understood, give a like to the video. Share my channel among your groups, among your friend circles so that more students can watch the video. Give your comment. Subscribe my channel if you have not yet subscribed. And by the super thanks which is given below my video. Inshallah, we'll continue the next topic in the next video.